Imagine a group of investors seeking to make money by investing in the private companies that are not traded on the stock exchange. This is called private equity. These investors gather funds from big institutions and wealthy individuals, forming what is known as a private equity firm. But what exactly is the role of a private equity in financial markets? Let's dive in. Private equity firms have a unique investment strategy. They plan for the long term, typically investing in companies for 5 to 10 years or even longer. Their goal is to increase the value of these companies by actively participating in their operations and decision making. They want to make the companies better, both for themselves and for their investors. One way private equity firms do this is by injecting large amounts of capital into private companies. This money can be used for various purposes, such as helping a company grow, acquiring other companies, or reorganizing operations. In some cases, private equity firms use a strategy called leveraged buyouts. This means they buy a controlling stake in a company by combining their own money with borrowed funds. This allows them to take the company private, make changes, and eventually sell it for a profit. At the heart of this ecosystem are private equity firms. These firms are like the conductors of an orchestra, orchestrating investments and managing funds. They seek capital from big investors such as pension funds, endowments, and wealthy individuals, forming a partnership. These partnerships are crucial for the firms to gather the resources necessary for their investments. Now let's meet some of the leading private equity firms that make up this world. First, there's the Carlyle Group, a prominent player in private equity realm with a global presence. They invest across a wide range of industries, leaving their mark on various corners of the world. We have the Blackstone Group. This firm is known for its versatility, engaging not only in private equity but also in real estate, credit, and hedge fund investments. Their multifaceted approach sets them apart in this intricate ecosystem. Another major player is KKR, also known as Kohlberg Kravis Roberts. KKR boasts extensive industry expertise and a global reach. Their involvement spans private equity infrastructure, real estate, and credit investments, making them a force to be reckoned with. Now let's shift our attention to investors themselves, often referred to as limited partners. These investors, which include pension funds, insurance companies, and even individuals with significant wealth, contribute their capital to private equity firms. They become part of the partnership and expect attractive returns on their investments. Within private equity firms, we find the general partners. These are individuals or teams responsible for managing the investments and making crucial decisions. They meticulously evaluate investment opportunities and actively engage with the companies they invest in, striving to achieve their value and generate substantial returns for the limited partners. Lastly, we have the portfolio companies. These are the private companies in which the private equity firms invest their funds. Imagine these companies as the pieces of a puzzle waiting to be optimized and enhanced. Private equity firms acquire significant ownership stakes in these companies, allowing them to play a decisive role in managing and shaping their future. The interconnected web of the private equity operates through a partnership model. Limited partners commit their funds to private equity firms, forming a powerful alliance. With these funds, the firms invest in carefully selected portfolio companies. The general partners take charge of managing and nurturing these companies, working to improve their operations and maximize their value. When the time is right, private equity firms exit their investments. This might involve selling the portfolio companies to new owners, who can take them to the next level, such as exits often bring attractive returns to the limited partners, creating a rewarding cycle of investments. As the story unfolds, limited partners assess the performance of the private equity firms. Based on this evaluation, they decide whether to continue investing in future funds. This dynamic relationship ensures a continuous flow of capital and opportunities within the private equity ecosystem. Now, it's essential to remember that this vibrant world of private equity encompasses a wide array of players, including smaller private equity firms, venture capital firms focused on early stage investments, and secondary market players who buy and sell existing private equity investments. The landscape is ever evolving, with new firms emerging and established ones adapting to market trends. Here's a step-by-step process of a typical private equity firm. Step 1. Fundraising. The adventure begins with private equity firms seeking funds from institutional investors and wealthy individuals. These firms create investment vehicles called private equity funds, and investors eagerly contribute their capital to these funds. It's like gathering a team of investors ready to embark on an exciting mission. Step 2. Investment strategy and deal sourcing. With the funds secure, the private equity firms craft a well-defined investment strategy. They carefully plan which types of companies, industries, and locations to target their investments. Like treasure hunters, they actively seek out investment opportunities. They explore multiple avenues, including connections with investment bankers, industry contacts, and conducting their own research. Step 3. Due diligence. Once a potential investment opportunity emerges, it's time for due diligence. A thorough investigation. The private equity firms delves deep into the target company's financials, operations, market position, and potential risks. They assess the company's strengths, weaknesses, growth potential, and competition. It's like examining a treasure map to determine its authenticity and value. Step 4. Valuation and investment decision. Armed with their knowledge from due diligence, the private equity firms puts on its valuation hat. They meticulously calculate the worth of the target company using various techniques such as analyzing financial statements and considering industry trends. They determine a fair value. Based on this assessment, the firm decides whether to proceed with the investment. It's like deciding if the treasure is worth pursuing. Step 5. Structuring the deal. Once the decision is made to proceed, it's time to structure the deal. The private equity firm and target company's owners or management negotiate and finalize the terms of the investment. They determine how much equity will be acquired, the price per share, and any conditions tied to the investment. It's like setting the terms of the treasure hunt, defining the roles, responsibilities, and rewards. Step 6. Financing the investment. To fund the investment, the private equity firm often combines its own capital with borrowed money. This combination, known as leverage, allows them to amplify their investment power. They secure financing from banks or lenders, finding the right balance between equity and debt. It's like gathering resources, including maps, tools, and provisions needed for the treasure hunt. Step 7. Active management and value creation. Once the investment is made, private equity firms become actively involved in managing the target company. They collaborate closely with the company's management team, sharing expertise and implementing strategies to enhance the performance. It's like guiding explorers on the treasure hunt, providing guidance and using their experience to unlock the treasure's full potential. Step 8. Monitoring and reporting. During the investment period, the private equity firm keeps a watchful eye on the performance of the portfolio company. They monitor progress, track key performance indicators, and address any challenges that arise. It's like tracking the progress of the treasure hunt, making sure the journey stays on course. Step 9. Exiting strategy and harvesting returns. After a successful journey, it's time to plan the exit. The private equity firm strategizes on how to exit the investment and realize returns for the investors. They may sell the company to another buyer, take it public through an IPO, or engage in a management buyout. It's like deciding how to unveil the treasure and reap the rewards. Step 10. Distribution of returns. Once the treasure is finally unearthed, the private equity firm distributes the returns to the investors. This includes the initial capital investment, profits generated, and the firm's share of the gains. It's like dividing the treasure among the explorers, ensuring everyone receives their fair share of rewards. Here are the top two private equity deals. In 2013, a monumental event unfolded in the private equity universe. Dell Technologies, a renowned technology company, embarked on a transformative journey, led by its founder Michael Dell and the private equity firm Silver Lake Partners. Dell went from being a publicly traded company to becoming private once again. The deal was valued at an astonishing $24.9 billion, making it one of the largest private equity transactions ever. Why did Dell choose this path? By going private, Dell could step away from the constant scrutiny and pressures of the public markets. It gained the freedom and flexibility to focus on long-term strategies, away from the watchful eye of shareholders seeking immediate returns. This strategic move allowed Dell to reinvent itself and explore new avenues for growth and innovation. Now let's turn our attention away to a remarkable partnership between Berkshire Hathaway, led by legendary investor Warren Buffett, and 3G Capital. In 2013, these two powerhouses joined forces to acquire H.J. Heinz Company, an iconic food processing company recognized for its ketchup and condiments. The deal, valued at a staggering $23.2 billion, sent shockwaves through the private equity world. This acquisition provided Heinz with a new lease on life. With the backing of Berkshire Hathaway and 3G Capital, Heinz had the resources and expertise to embark on exciting strategic initiatives. The goal was to optimize operations, enhance efficiency, and drive the company's growth to new heights. Under this partnership, Heinz could focus on a long-term vision, free from the demands and pressure of the public markets. It's like giving Heinz the room to explore its flavor palette and create even more delectable offerings. Now let's explore the thought-provoking blog written by Rahul, a seasoned private equity analyst who shares his personal insights and experiences. Let's delve into the key takeaways from Rahul's blog and gain a deeper understanding of the private equity industry. Rahul begins by vividly describing the role of a private equity analyst through his own lens. As an investment analyst in private equity, I was at the forefront of driving investment decisions. My responsibilities range from executing deals to sourcing new opportunities to managing portfolios. Drawing from his personal experience, Rahul highlights the crucial skill set required for success in private equity. A strong grip on corporate finance, the ability to assess risk, and analytical thinking were fundamental to my role. But equally important were demonstrated leadership, teamwork, and proficiency in Excel and PowerPoint. Through anecdotes, Rahul shares the rewarding aspects of a private equity stint. Mapping revenue and cost drivers, crunching through mountains of financial data, and building relationships with industry professionals were exhilarating. Plus, the potential for attractive compensation made the journey even more fulfilling. Rahul also offers a practical advice based on his own journey. To enhance my role in learning, I took ownership of various work streams and deliverables. By actively participating in deal negotiations, I gained expertise in legal nuances. Building relationships with internal stakeholders and attending industry conferences opened doors for business development opportunities. Reflecting on his interview, Rahul shares his experience. The interview process was rigorous, involving financial modeling tests, case studies, and assessing cultural fit. I learned the importance of being well prepared and demonstrating my passion for the industry. Furthermore, Rahul explores their potential exit options. Many private equity analysts pursue an MBA to further their education and career prospects. Others transition to different firms within the private equity or venture capital space, leveraging their expertise. Some even explore operating roles within industries, applying their knowledge to drive the value in new ways.